Accounting standards, key IFRS IAS standards. Accounting standards provide a structured set of principles and rules that ensure financial statements are consistent, transparent, and comparable across different businesses and industries. The International Financial Reporting Standards, IFRS, and International Accounting Standards, IAS, set the foundation for global financial reporting. This section will cover the importance of accounting standards, key IFRS and IAS standards that govern financial reporting, their application in financial statements. 1. Why are accounting standards important? Without accounting standards, companies could report financial information inconsistently, making it difficult for investors, creditors, and regulators to analyze and compare financial statements. The key objectives of IFRS and IAS are to ensure consistency in financial reporting worldwide, improve transparency for investors and stakeholders, allow for comparability between different businesses, provide a framework for fair and accurate financial reporting. 2. Key IFRS and IAS standards. A. Revenue recognition. IFRS 15. IFRS 15. Revenue from contracts with customers outlines a 5-step model for recognizing revenue. Identify the contract with the customer. Identify performance obligations within the contract. Determine the transaction price, how much will be received. Allocate the transaction price to performance obligations. Recognize revenue when performance obligations are met. This standard ensures revenue is reported accurately and reflects the actual delivery of goods or services. B. Leases. IFRS 16. IFRS 16. Leases requires companies to recognize most leases on the statement of financial position. Lessee accounting. Right-of-use asset, recorded under non-current assets. Lease liability, recorded under liabilities. Lease payments are split between depreciation and interest expense. Lessor accounting. Finance lease. Lessor recognizes a receivable instead of the asset. Operating lease. Asset remains on the lessor's balance sheet, and lease income is recognized over time. This standard prevents companies from hiding lease liabilities off the balance sheet, ensuring transparency. C. Property, plant, and equipment. IAS 16. IAS 16. Property, plant, and equipment governs the recognition and measurement of tangible assets such as buildings, machinery, and vehicles. Initial recognition. Assets are recorded at cost, including purchase price, delivery, and installation costs. Subsequent measurement. Cost model. Asset remains at historical cost, minus depreciation. Revaluation model. Asset is revalued periodically to fair value. Depreciation. Spreads the asset's cost over its useful life. Derecognition. An asset is removed when sold or no longer provides future benefits. This standard ensures that fixed assets are properly accounted for and depreciated over time. D. Impairment of assets. IAS 36. IAS 36. Impairment of assets requires companies to assess whether assets have lost value. When to test for impairment. Indicators of impairment, e.g., declining market value, operational losses. How to measure impairment. Compare the asset's recoverable amount, higher of fair value or value in use, to its carrying amount. If carrying amount exceeds recoverable amount, impairment loss is recognized. This prevents businesses from overstating asset values. E. Provisions and contingencies. IAS 37. IAS 37. Provisions, contingent liabilities, and contingent assets ensures that companies recognize only genuine obligations as liabilities. Provision. A liability is recognized when there is a present obligation from past events. An outflow of resources is probable. The amount can be reliably estimated. Contingent liabilities. Not recorded but disclosed if an obligation is possible. Contingent assets. Only recognized when virtually certain. This standard ensures that companies do not manipulate financial statements by hiding liabilities or overstating assets. 3. How accounting standards affect financial statements. Statement of Financial Position, SOFP. IFRS 16 requires lease liabilities and right-of-use assets to be reported. IAS 16 affects how property, plant, and equipment are measured. IAS 37 ensures that provisions for future obligations are recognized. Statement of Profit or Loss, SPL. IFRS 15 impacts revenue recognition timing and measurement. IAS 36 affects net profit when impairment losses are recorded. IAS 16 includes depreciation expenses, reducing profits. Statement of Cash Flows, SCF. IFRS 16 changes lease payments from operating to financing cash flows. IAS 16 influences cash outflows for asset purchases and disposals. Accounting standards ensure financial statements accurately reflect a company's financial health. Test your knowledge. Multiple choice questions. Q1. Which IFRS standard governs revenue recognition? A. IFRS 9. B. IFRS 15. C. IAS 16. D. IFRS 16. Q2. Under IFRS 16, how should a lessee account for most leases? A. Recognize lease payments as an expense. B. Record a right-of-use asset and a lease liability. C. Ignore leases unless ownership transfers at the end. D. Recognize lease payments only when paid. Q3. According to IAS 36, when should an impairment loss be recognized? A. When the carrying amount of an asset exceeds its recoverable amount. B. When an asset is fully depreciated. C. When market interest rates increase. D. When an asset is sold at a gain. Leave your answers in the comments. Did you get them right? Let us know in the comments. Like this video if you found it helpful and subscribe for more ACCA, IFRS, and financial reporting content.